Ben Reppond. Welcome to my YouTube broadcast. Today is February 28, 2024. What is being talked about in financial circles is artificial intelligence, AI, and NVIDIA. NVIDIA is kind of a proxy company for AI. They specialize in technology that facilitates AI. There are other companies where AI is part of their model, or emerging companies that are specializing in AI. This is very similar to other technologies or stocks in the past. Over time, these companies have become old economy companies, but at the time, they were just as popular and just as in demand as NVIDIA and AI stocks are today. You can go all the way back to 1634 to 1637 and look at tulip mania. The technology at that time around tulips, and particularly these exotic tulips in Holland, and how they were produced, drew money in from wealthy people and average people. And the price of tulips went incredibly high as about, I've read, $750,000 per bulb in today's dollars. And you may think, oh, that's crazy. I would never do that. They must have been stupid. No, they weren't stupid. They were just as smart as you and me. But what they had was what we have, and that is human emotion. When things go, whether it's Bitcoin or AI or tulip bulbs, when they go up and up and up and up and up, eventually the world pays attention, and eventually a lot of people say, we all want to do this. I want to get on board. And there's nothing wrong with that. But when you get on board, the further up it goes, the further down it falls, according to economist Hyman Minsky. So we've had other examples of this in the U.S. economy. You go back to the earlier part of the century, and you have companies like Union Pacific Railroad, U.S. Steel, banks, other companies that have done very well. And then eventually, and I think of then Sears, RCA, Motorola, eventually these companies run out of steam, competition comes in, earnings diminish, and they crash. Sometimes they crash several times. Since 1950, there have been some others, Boeing, IBM, JCPenney, Woolworth, and of course you can't forget the Penn Central Railroad. So there's a lot of examples of companies that were hot or popular or drew in investors. They were the place to put your money at a point in time, and then they weren't. So I think of NVIDIA and AI not as a bad technology, nothing wrong with it. I think it's going to do well. I think those people that want to get on board with something like that and they do it, I understand that. But just like others in the past, there will come a time where something will replace it, or competition will come in, or earnings will diminish, and they will come down. I couldn't think of a single example of a company. The best example I could think of was Microsoft, who started out, did very well, and is doing very well today. But Microsoft has endured its own crashes, and it came down over 80% in value during the early 2000s, during the dot-com crash. When many companies did go out of business, Microsoft lost 80% of its value, and they were among the fortunate. But they were the ones that I think that's done the best over time. But I couldn't think of a single example outside of that. And so that has not gone through one or more crashes of 50 to 80%. And if Microsoft is my best example, I would say, okay, are you ready for an 80% correction? Because that can happen again. So if you want to invest or are invested in AI or NVIDIA, okay, just be careful. Okay, I want to get into the dashboards. The first dashboard is on the stocks. These are 4 U.S. indexes, the Dow, the S&P, the NASDAQ 100, and the Russell 2000 small cap index, and 2 international indexes, the emerging markets and developed markets. And you can see in the green dots on the right show the, are they above or below their 20, 50, 100, and 200-day moving averages. And you can see where they are. The pink box shows the year-to-date results. So here we are at toward the end of February, and you can see that the top ones are the S&P and the NASDAQ 100. They're up over 6%. And the worst one by far is not an equity index, but I put it in here just to see it, is the 20-year government bond ETF, TLT. It is down over 5%. So when some people invest in 60-40 portfolios, stocks and bonds, TLT, or the long-term government bond, isn't necessarily the one or the only one that they invest in. They could invest in corporate bonds or intermediate term bonds, etc. So, but this one just happens to be 5% down. But what it tells you is that probably that other kinds of bonds are also down, and down probably a fair amount. So that is weighing against equities. So if people are invested in equities, the bond portion weighs down those buy and hold portfolios. When you break apart the S&P 500 and look at the 11 sectors, you can see again to the far right that most of those are above those same 4 moving averages. So that's a positive indicator. The one that is not is telecommunication, and it is below all 4 of those index, or all 4 of those moving averages. And then the real estate is below its 50-day moving average. So all the others are above all their moving averages. That's positive. The rate of return starts at the high of 8%, goes all the way down to a positive 1%, and then the last 2, telecommunication and real estate, are negative over 3%. The S&P 500, when you just look at the composite of the S&P, this is the 500 stocks, bring them back together now, again, had another up week. And here we go from October of 2023 to present, and I put a black arrow, you can see the trajectory. The market is up. The S&P 500 is up. Yes, there were components of the market, which I just showed you, which are negative, but by and large, the broad market is up. The other way I separate the S&P 500 is with growth and value. Looking at the growth stocks, Google, Apple, Microsoft, Amazon, etc., to the value stocks, companies like Boeing and Costco and Ford Motor and Pfizer, etc. Those companies, very different kinds of companies. Those are value companies, more focused on profits. So when I compare those, putting the growth stocks as the numerator, the value stocks as denominator, you can see when it goes down, it favors value. When it goes up, it favors growth. So you can see from the black arrow the period of time that goes from sometime in October of this last year up to January. Value was definitely in favor. Beginning in January, growth has become in favor, represented by the red arrow. So you can see over that period of time which types of stocks tend to be in favor. Looking over an 18-month period, I put a black arrow from March of 2023 to present, almost a full year. You can see the trajectory has been up and down, but the trajectory has definitely been favoring large companies, SPY, the S&P 500, compared to IWM, the ETF for the Russell 2000 Small Cap Index. So it's a good way to see not only what types of stocks, but what size of stocks are in favor. The long-term government bond, as I showed in my earlier slide, the long-term government bond, the ETF is TLT. When things are going well, when interest rates are going down, this is going up the most. However, when interest rates start to go up, this comes down the most. So this is a 4.5-year period, 54 months, that shows a direction. There is clearly some up and there's clearly some down, but the long-term trajectory over 54 months is negative, which shows that the interest rates or the perception of where interest rates are going is definitely upward. The dollar continues to go up, and I gave a long-term picture here. This is a 30-month picture of where the dollar has gone, and this is relative to other currencies. So the currencies we most compare to are Europe, but you could say Europe and Japan, and the dollar looks very good compared to those. I saw something recently, and I wanted to just mention this to you as I was thinking of the strength of the dollar. So if you have traveled abroad, you would appreciate this. So I saw something, it said something about foreign travel, airfares. And so from the U.S., this was literally from the U.S. to Europe. This was on the website of kayak.com. Flights as cheap as $108. Hard to imagine, $108. Round trip, I'm assuming, is about double that. And another one from Expedia, flights as cheap as $122. Wow. And that's all because of a chart like this that shows the strength of the U.S. dollar. Gold had a good week, an up week. You can see that tick up at the end of the chart. And of course, the long-term trajectory has been positive. Silver, on the other hand, has not been as positive. It was last week, but this week it's down. So gold's up, silver down. That's unusual because they tend to correlate. But the long-term trajectory is still positive, or I'd say intermediate-term trajectory. When I compare silver versus gold, silver numerator, gold denominator, look over about a year-plus period of time, you can see that the rate of change, the change from gold to silver relative to where it was, gold has gone up more than silver, which is why it's declining, and silver done less well. Bitcoin continues to do well, and this is last week. Today, as I record this, Bitcoin's up again. So this is over a 1-year period of time. Volatility went down. So what that indicates, this is volatility of the S&P 500. So what that indicates is that the volatility, the downward pressure, when stocks go up in value, that the volatility index tends to go down. And when it goes down, that's a positive indicator. I put a black mark at 24, which is my threshold, where I believe that if it moves up above that, things are starting to move in a more negative direction. We're quite a ways from 24. We're all the way down to 13, and it came down from 14 to 13 last week. Asbury Research has all 6 of its indicators as positive. It's a mixture of fundamental and technical. Asbury Research also does comparisons of one asset or asset class to another. For example, stocks versus bonds, stocks are doing better. And you saw that in my dashboard, right? The stocks were clearly doing well and bonds were clearly doing poorly. Large cap versus small cap. Large cap is clearly doing well. The broad market, the S&P 500 versus the Dow, broad market doing better. Broad market versus the technology, the NASDAQ 100, broad market clearly doing better. Growth versus value, growth is doing better. These are measured, all three of these columns are the last week, the last month, the last quarter. And the U.S. is doing better than developed markets, and in most cases doing better than emerging markets. High yield is doing better, that's junk bonds, doing better than corporate. And junk bonds tend to follow generally follow the direction of equities as well. The U.S. market is, when compared to all other markets in the world, doing better than most of those markets. Japan had they outperformed the U.S. in the last month and the last quarter, but not the last week. So where the U.S. is shining right now in all three categories are Chile, Brazil, Canada, Mexico, Switzerland, Spain, UK, Malaysia, Singapore, Taiwan, Thailand, and Australia. And the others are mixed. So really a mixture of Latin America, Europe, and Asia. I picked this chart. I did a relative strength chart between the S&P 500, SPY, and Switzerland as a surrogate for Europe. This was the most pronounced example. And when it goes up, this favors the U.S. When it goes down, that favors Switzerland. So you can see over the last, 9 months or so, the direction that the U.S. market has been compared to others. Excuse me. So there are markets in all parts of the world which are struggling, and economies that are struggling relative to the U.S. And the U.S. is kind of sitting out there right now as really outperforming in both economics and in the market other developed countries and even underdeveloped countries. Okay, gold and silver. As of last Friday, the 23rd of February, gold, as you saw that tick up in my gold chart, is up 1.1%, up to $20.37 per ounce on the spot price. The silver is to $23.01, down 2%. So you saw that also. So one was going up, one went down. The gold-silver ratio is still at about 89-1. If you want to buy a monster box, which is 500 rounds of silver, that's $12,130, which includes, and this came down, last week was the first time this came down, it's still down, $1.25 markup. That's per ounce. That's pretty low compared to where it's been. It's been up in the $2 to $2.50 range. So for 500, if you buy quantity of 500, that's $24.26 per round. And if you buy a tube of 20, that's 50 cents more per ounce, which is $24.76. According to my son, Preston, who sells them at those prices. And I think that's a good benchmark for you. While wages have been going up, there's a drag on wages, and that's called inflation. So real wages, inflation-adjusted wages, are actually going down. Thank you for watching. If you have questions or comments, leave them in the comment section below.